Dear viewers, welcome to this edition of Your Life, Your Money. What is it I'm going to talk to you in this episode? About your retirement. You have worked hard to build the retirement corpus. Now you are about to retire or you have just retired. In this episode, I'm going to talk to you about 9 ways your retirement can get ruined. That's because of your negligence. Let's understand these 9 points a little bit in detail. This is NRI Money Clinic for you, and I'm Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, let us look at these 9 points which can ruin your retirement one by one. Point number 1, overspending on your children's education. You have to be very, very careful. Late marriages have a problem because of which children arrive late in the families. By the time you retire, your children are still studying, or you may have unfinished responsibilities towards your children. When it comes to question of children, parents become emotional, rightfully, but when it comes to question of emotion and being rational, you should follow the rational path. If it is your children are really good in studies, they will get good scholarship, they'll get good admissions with the government seats or the fee which you can manage. Governments have also come out with an initiative to give education loan for these students. So you make best use of either the scholarships or the loans given by different banks for education of your children. Do not overspend on your children's education. At the same time, you should have a discussion with your children when they go to around 10th standard that their higher education should be funded from the education loan, and the responsibility of clearing this loan is exclusively with your children. Don't become emotional. I'll make it so easy for your children. No, not required at all. Let's imagine a situation if your children are 18 years old and they don't study and they start a business. Will you be funding the business? You obviously will not be funding the business. The education today is nothing but a business. Children who graduate around 21, 22 years of age today find a job and they'll have cushy salaries, but they don't get married. They don't fall into the family responsibilities. Lots of cash in their hands. They should use this money to clear the loans they have taken for their education. That's the right way. Likewise, children do not need to do master's courses immediately as per the new education policy or what we see in the marketplace. It is not essential that you have to do the master's immediately after the graduation. They can take up some assignment, they can build some funds, they can take 1 or 2 years of experience, then apply for a course which is more useful for them to propel themselves into the next level of career. Trying to do a master's immediately after the graduation may or may not work in their favor, and it may leave a big dent in your funds as well. So be careful with this and don't get over conquered with your emotions. Have a factual talk with your children and tell them the responsibility of clearing the education loan is theirs. Point number 2. Most salaried people are not used to handling big sums of money. They live from paycheck to paycheck. At the end of the month, they have very limited amount of money. What happens when they retire? When they retire, big chunks of money will come in the form of closure of provident fund account or end of service benefits, gratuity, and various other things. Suddenly you see a big chunk of money coming into your bank account and you do not know how to handle it. Do you know what people do with this money? There are a lot of people who go and buy property with these large chunks of money, and they think buying a property is the best thing. It will appreciate over a period of time and it will give them the rentals. But it has its problems. If you buy into a residential real estate, the rental yield you get is just about 2%. If you keep the same money in the bank may give you 4, 5, 6, 7% depending on the interest of the day, and it will remain liquid. You don't need to maintain, you don't need to pay the taxes. So do not do the mistake of buying a residential property using your retirement corpus unless you do not have a roof above your head. Even in such a case, make sure you buy a smaller one, what you can manage, and it will not compromise on the liquidity during your retirement days. Buying into a large property, spending a large chunk of your retirement corpus is inviting trouble. Point number 3, not having equities or derivatives of equity. I'm not telling that options and futures here, but one or the other forms of exposure to the stock market, be it a pension account which has an equity component in it, or the mutual fund, or an ETF, or an index fund, or direct equity. At least some portion of your retirement corpus must be in the equities. Because I'm a retired person, I do not have a risk taking ability. That's not very correct. Gone are the days where people will exit this world within 5 to 10 years of the retirement. Those days are behind us. Today, if you retire at 60, the chances of you living up to 85 to 90 years is very, very real, which only means to say if you over depend on the fixed income, the inflation will drive a big hole in your cash flows and you may not be able to sustain your life very well in 10-15 years from the day you retire. So it is absolutely essential that you have some exposure to equities. At least I would say 30% of your corpus should be parked in the equities under the guidance of professional advisors. Mistake number 4, when you retire, because of your pensions, because of the interest, you have a hefty amount of money coming into your bank account. Most retirees will become very itchy at this point of time. Do not do the mistake of consuming all your retirement income. You may have rents, you may have pension accounts, you may have bank interest which is coming in, you may have your own other cash flows which could be coming into your account. Like the way you are following a method of saving during your earning phase, follow the same method during your retired life at least up to 75 years of age. If you are having 100 units as your cash flow, make sure you use 70% and at least 30% of that must be reinvested in instruments which can beat inflation. It could be a low equity exposure mutual fund, it could be a hybrid mutual fund, or you pick up an instrument which is more suitable to you, be under the guidance of professional advisors, but make sure you do not consume all your retirement cash flow and you reinvest this. Why we should do this? The reason is very simple. The good news is that you are not going to die soon. The bad news is that you may run out of your money. If you are not careful at this stage, between 60 to 75, and if you do not reinvest a portion of your money, and in case if you survive beyond 75 years, which in most cases you will, then you will struggle for money. Don't do this mistake. At least 30% of your retirement corpus, please do reinvest. Number 5. This is an emotional mistake. Do not share your financial details with your children. Understand the difference here. I'm not telling you should hide it completely. You should record it. You should prepare a will. Your spouse should know about it. But do not give a blueprint of how much money you have, where you have, all these things. Don't try to make it the details in front of your children. It should not be known to your children. The reason being, they are your children. You are connected to them in an emotional way. Tomorrow, if a demand comes from your son, daughter, or your son-in-law or daughter-in-law, you will find it difficult to say no. If you say yes, you will not get back the money or you will spoil your relationship. So do not do the mistake of disclosing the amount of assets you have in front of your children or their spouses. The right way to do it, record it well, create a will, inform your spouse, give her the required instruction not to disclose with her children at any point of time. This should go on till the end of your life. Maybe at the fag end of your life, it's fine to disclose these things, by which time you have established your relationship with your children and their spouses. At the same time, children have also stabilized. Mistake number 6. Now that you are retired, you have lots of money in your bank account. It's just not that you know about it. The world around you knows about it because everybody gets a retirement corpus when they retire. What happens? There are a lot of people who come and ask you to stand as a guarantor to the loans. It could be a friend, it could be a neighbor, it could be a relative, it could be your children, it could be anyone. Please stay clear of standing a guarantee for any loans. You can be ruthless, you can be politely telling them, no, I do not have a risk profile to stand as a guarantor. I do not have my wife's permission for that. My children will not allow to do that. So do not stand as a guarantor for any loan once you are retired. You should be very, very clear in this. And if you make it very clear, at least you know one thing, your money is safe. If you stand as a guarantor and if the loans go bad, then you lose money and you lose relationships, both. If you say no to standing as a guarantor, at least your future, your money is safe in your hands. If your relationship is only because of the money, let the relationship get spoiled. Mistake number 7. When you are a retiree, do not chase return. Return of capital is more important than the return on capital. Yes, your money should earn a good rate of return, but do not chase return. Let me explain here what is chasing of return. For the lure of return, you will be investing in a small cap fund. You will be investing in a small cooperative banks. You are doing a private lending to somebody else thinking that they will give you a higher rate of return. All these things are fraught with severe risk of losing the capital. So when you are retired, these are your golden years. The purpose of having your money is to make sure that you have adequate money during your retired life. Here you are not aiming to create a wealth creation. You are in a distribution phase of life. You should have adequate liquidity. The liquidity that you should have should at least stay in sync with inflation, or over longer periods of time try to conquer the inflation. Understand, you are not trying to create wealth here. You are trying to make sure that your cash flow stays relevant in your life. If you are getting, let's say, 50,000 rupees as a retirement corpus, obvious over a period of time it loses its value because of inflation. As long as it keeps in line with inflation, that should be fine. But if you are a 30-year-old person, your approach is different. There you need a wealth creation. There you need a risk-taking ability. Understand, you are a retiree and safety of your capital is paramount. Under no circumstances, trade this safety for the sake of returns. Mistake number 8. It pains me to say this, but I need to tell you, be careful with the advisors. There are a lot of people who come to you, they know that you have got money and they have a business to support. They may advise you wrongly. I have seen people go to bank and the banks know that you have got a large chunk of money deposited into your account. There are vultures around these bank branches telling you, you do this and you do that. My sincere suggestion is, you should stay clear of such advisors, or in the guise of advisors who are asking you to put your money into schemes which does not suit your requirement. You should take time. You should consult professional advisors. I sincerely advise that at least by the time you retire, you have good contact with one advisor with whom you can really trust. See, at 60, you don't have an advisor and anybody comes into you. It takes time for you to build trust with such people. It is better you have an advisor throughout your life. If not, at least as you move closer to your retiring years, try to build a relationship with one good advisor. You can find out from your own area who can do a better job for you. Do not invest unnecessarily into the insurance plans. Do not unnecessarily put your money into ULIP plans. If you are putting that money into this, you should convince yourself why I am doing this, how it makes sense. Otherwise, 58, 60 years of age and you get into an insurance plan and the cost of insurance itself can drain the returns that is coming into those plans. So make sure that if you are buying something, it is in your best interest. Don't take any advisors at the face value. Challenge it with a common sense. If you think, yes, there is a possibility that you can work with them, take your time and see whether you are taking an emotional decision. Ask questions from your common sense. If all those things answer you in the right way, then only you proceed. Even there, have an exposure control. Don't do the mistake of putting everything in one single time or one single place. That works in your favor. By the way, if you are looking out for professional assistance to manage your retirement funds, then you can make best use of services offered by NRI Money Clinic. We have a team of professionals working under our guidance here. You can make best use of these persons, whether it is in India or outside of India. If you have an intention and if you want the services of an advisor, do contact us through WhatsApp. Our numbers are given here in the description box, and we have also given a link over there. Just click on the link and it will take you to the WhatsApp. Send us the message, and my team of experts are ever ready to help you on that. The last point I'm going to talk to you is the most important part. When you are fit and fine, you do everything yourself. Life beyond 60 is at the mercy of God. What happens when you are at 65, 70, you do not know. In most families, the ladies of the house do not take interest in the family finances. I can say over 95% of the ladies do not take interest in the family finances. Now imagine a situation where you have created very complex financial plans, you have put money in lots of places, you have put money in different properties in different geographies. What if you were to fade away from the scene? Can your wife handle this? Ask this question. They will not be able to handle this. They will come under the influence of other members of the family or relatives, and they are going to ruin. In your planning, your wife's interest should be paramount. Think when you are investing money in somewhere, can my wife handle it? Is it easy for her to handle it? Can she get the same level of cash flow when I leave this world? If statistics are to be believed, women live longer than men. It's obvious. So the probability that the spouse lives longer, when I say spouse, the wife lives longer than men, is very, very real. So make your plans very, very simple. Don't create complex structures around it. Make sure that she has a steady income even in your absence. A pension plan could be fine, a rental account could be fine, a fractional commercial real estate could be fine, a hybrid mutual fund portfolio could be fine, but make it simple and explain to her and tell her very clearly in your absence whom she should approach and whom she should not approach. Tell her what she needs to do and what she should not do. These small finer points, make sure in your absence, the interest of your wife is never compromised. Dear viewers, hope the video I've done helped you to understand what are the possible mistakes you may get into during your retirement years. Be conscious about this fact, and if it did help you to avoid these mistakes, do give me a thumbs up. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, do hit the subscribe button now and press the bell icon. Don't forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Friday with yet another thought on your life, your money. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.